We have some breaking news for everyone's favorite dividend ETF. SCHD, effective after the market close on October the 10th, will undergo a 3-for-1 share split, which ultimately means at the end of the market on October the 9th, if you were to have one share, the post-split price on October the 11th will essentially be 3 shares for that equivalent. So a quick example, say someone has 10 shares of SCHD. Ultimately, when the split takes place, they will now have 30 shares. But what is very important to understand is that the total value of your investment will not change. What effectively this means, the shares that you will have will now be trading at 1/3 of the value. For example, to make this a lot more simple, if you have one share at $90, this will then become 3 shares that are trading for $30 each, still equaling your total investment of $90. Now, do bear in mind this doesn't just apply to SCHD. There are other ticker symbols within Schwab where they are also doing a split ratio. So, for example, if you are invested in SCHG, they are doing a 4-for-1. And we can see this is pretty much right across many of the ETFs that they do hold. So very interesting to note, and we also want to go through exactly why this ETF is very popular. Now, firstly, bear in mind it is up around 19% over the last 12 months, and over the last 10 years, up around 120%. Now we're going to show you it has marginally outperformed the S&P as well over this duration. And what's interesting to note, right now it is trading right towards its 52-week highs, and we can see Seeking Alpha do believe that it is a buy, Quant on the other hand giving this a hold. One reason why we do love this ETF, the expense ratio is very, very small. We're going to show you in comparison that it's at 0.06%, and the forward yield is very attractive at 3.48%. As we said, dividend investors do think of this in very high regard, and a lot of people in this community do hold this within their whole portfolio. Now, as we mentioned, expense ratio is very, very low. Effectively, this is the cost for that management charge to run the ETF as a whole, 0.06%. Reason why they get an A+ here, as we can see, the median of the majority of ETFs is around 0.49%. What this ultimately means is that you are paying less invested in SCHD for management to run as opposed to the ETFs on a median basis. We also note that a lot of people have this because of the dividend yield, but also one thing that you shouldn't forget is dividend growth. Over the last 10 years, we can see some very attractive increases on a year-on-year basis, and they just recently announced alongside the 3-for-1 stock split that they are doing in this latest quarter a 15% dividend increase. And for those that want to see it on a numerical basis, well, over the last 5 years, on average, year on year, they've been increasing the dividends at 13%. Over the last 10 years, double digits at 11%. So very strong, not just an attractive yield of 3.5%, but they are also increasing the dividend at a very, very attractive rate. And the reason they can do this, because when we take a look at just their top 10 holdings, these are typically what we would call dividend growth companies. For those that maybe are less likely, like Verizon, do offer very high yields to begin with. And as we can see here, some very big well-known names. Largest position sits at the Home Depot, 4.26. We then have Verizon not too far off at 4.21, as well as BlackRock at 4.17. Now, we also want to compare this to other ETFs, especially for those that are looking for dividends as their main source of income. And the first thing we want to highlight, SCHD, pretty much alongside VYM, which is the Vanguard High Dividend Yield Index, have low expense ratios in comparison at 0.06%. Now, what's important to understand is not only do we want to select ETFs that have low expense ratios, but also we want equally their performances to be very, very strong. So over the last 12 months, including reinvesting those dividends, so total return, SCHD has been towards the lower end at 24%, but still very, very respectful. In fact, we can see DVY the highest at 30.2. When we expand this over the last 10 years, what we get here, in fact, is SCHD up 203.24%, only beaten, as we can see, by DGRO. And for those that do want to know, DGRO does have, although marginal, a higher expense ratio at 0.08%. So you would be happy with this. And what's very interesting to note as well is that when we do compare it to the S&P 500, over the last 12 months, again, reinvesting those dividends, SCHD is up 24%, S&P 500 up 34%, so you would have underperformed over the last 12 months. When we expand this to over the last 5 years, a very similar result. 94% for S&P, 84.08 for SCHD. However, when we do zoom out and look over the last 10 years, we do see, although marginal, SCHD has outperformed the S&P 500. Now, as always, past performance doesn't indicate anything towards the future. With SCHD, it could perform marginally better, it could perform marginally worse than the S&P 500, but investors will have their reasons for looking at ETFs like SCHD as opposed to low-cost ETF alternatives that track the S&P 500 like VO, SPY, and some others. Now, there will be some investors here who also want to invest in individual stocks, and on this channel we do cover that a lot, so do subscribe and hit that bell button so you are continually notified when we do release in-depth reviews of individual companies. But we also want to let you know that every single Monday, so a new one is dropping tomorrow morning, we take a look at some undervalued companies that you should consider in your portfolio, as well as what's happened in the market just over the last few days. Now, tomorrow morning, alongside just the weekly newsletter, we will be dropping a spreadsheet containing 36 undervalued dividend stocks for your consideration for the month of October, where we're also going to take a look at seeing which one we also have in our portfolio and do find attractive. On top of that, right now you can grab a copy where we look at 22 dividend stocks that have the most upside over the next 12 months according to Wall Street. So go ahead, click on the pinned comment below and sign up. As always, hope value was provided, and we'll see you all on the next one.